Look, Betty, Exxon's numbers are great, right? $9.5 billion profit is huge, but it was due to better margins in its chemical business. Exxon is still dealing with lower oil prices and weak production. Oil equivalent output was down about 3.5% compared to last year. So the problem? Well, Energy Aspect says that returns for oil majors actually peaked in 2005 when Brent averaged $54, as exploding CapEx eats away at free cash flow. So this chart shows Brent prices over the last 20 years. We're trading around all-time highs, right? Well, this yellow line, though, shows the ratio of big oil's net income and the oil price. So for each dollar oil has risen, net income has actually been falling. And why is that? Capital expenditures. Costs have tripled. So between 2005 and 2012, CapEx has grown a whopping 16% a year, all the way to $600 billion, Betty.
So what is behind the surge in CapEx, Alex?
Well, the oil business is already CapEx heavy because it costs a lot to keep existing fields flowing. For example, Exxon investing $41 billion in CapEx this year alone. That's exploration, LNG terminals, oil platforms, refinery maintenance, you name it. Now, that number is nearly triple the amount in 2007, and the company still sees total production down 1%. Here are some of the issues: equipment, security, labor. All cost more, but the deeper issue is that the easy, cheap oil has already been found. Decline rates are higher and newer finds are smaller, which means only the expensive oil is left to find. Philip Weiss over at Argus Research actually says it's Chevron that has the best profitability in the space, and it still makes only about $20 to $23 per barrel, and that doesn't include taxes. And all of this means less returns for investors. Betty, big oil shares have gained an average of 2% this year versus the S&P at 11%.